Picture yourself walking into a casino.
Okay, I'm there.
You know, you have the flashing neon lights, the hum of the slot machines, the heavy chips clinking on the green felt tables. It feels chaotic and, well, wildly unpredictable.
Right. Very overstimulating.
Exactly. But beneath all that engineered noise, there is an incredibly rigid, unforgiving structure at play. I mean, the house tells you the maximum bet. You exchange your cash for a finite number of chips, and when those chips are gone, the dealer does not look at you and ask if you want to keep playing on hope.
No, they definitely don't.
Right. The game simply stops. The casino environment provides hard, non-negotiable limits.
And that's key because the boundaries in that scenario, they're completely external. Like they're imposed upon you by the actual architecture of the game itself, which ends up shielding you from your own lack of discipline.
Yeah, that makes a lot of sense.
You don't have to decide when the game is over. The math and the dealer, they make that decision for you.
And that brings us to the core of today's deep dive. Welcome, by the way. Today, we are analyzing a stack of foundational texts on behavioral finance and trading psychology.
That's some really fascinating material.
It really is. Our mission for you today is to unpack a psychological nightmare that hides inside what most people consider, an absolute dream.
Yeah, the dream of unlimited wealth.
Exactly, because when you step out of that rigidly structured casino and log into the stock market, you are entering what is arguably the only game in the entire world with no beginning, no end, and absolutely no built-in limits.
We are looking at a fundamental paradox today.
Yeah.
Culturally, we are taught to desire unlimited potential, right?
Oh, yeah. Sky's the limit.
Exactly. The idea of boundless opportunity, this unlimited potential for profit, that sounds like ultimate freedom. But the behavioral finance sources we're analyzing, they reveal a much darker reality.
Which is what exactly?
Well, this exact mechanism, the total absence of environmental boundaries, is precisely what blinds market participants to the risk of losing everything they own. It is a profound psychological trap that literally turns our own biology against us.
Wow. Okay, so let's dismantle this trap, starting with the source text's crucial distinction between gambling and trading. Because on the surface, moving from the strict rules of a blackjack table to the boundless freedom of the financial markets, it sounds like a massive upgrade for someone seeking wealth.
It sounds like taking off the training wheels.
Right, exactly. But the psychological reality is entirely different, because when you place a bet in a game of chance, your risk is entirely predefined. Before the dice even leave your hand, the parameters of your potential loss are completely locked in.
Yeah, you slide your $20 across the table, and that $20 represents the absolute unchangeable boundary of your risk in that specific isolated moment in time.
The event has a clear beginning, middle, and end.
Precisely. But trading, on the other hand, operates in a continuous, uninterrupted flow of information and price movement. When you enter a position, you never truly know how far a price will travel or, how long it will take to get there.
Because it's just always moving.
Right. And because the market has the theoretical capacity to go anywhere, it triggers a phenomenon the authors call the illusion of fulfillment.
The illusion of fulfillment? That sounds incredibly aspirational, but the texts paint it as highly toxic.
Oh, it's incredibly toxic.
It's the subconscious belief that because there is no artificial cap on how high an asset's price could climb, every single trade possesses the latent potential to fulfill your wildest dreams of financial independence.
Yeah, it warps your perspective completely.
You stop looking at a trade as a single probabilistic event within a broader system, and instead you start looking at it as your personal lottery ticket to absolute freedom.
Yeah.
But let me push back on this a little bit.
Yeah.
Isn't optimism supposed to be a good thing? Like, we're taught to think big.
Well, we can connect this to the broader architecture of human psychology. Healthy optimism, the kind that drives human progress, requires a grounding in structural reality.
Okay, what do you mean by that?
Like, you might be fiercely optimistic about launching a new tech startup, but that optimism is checked by the realities of a business plan, a limited runway of capital, market research, legal constraints. There are walls.
Right, you can't just operate on pure belief.
Exactly. The financial markets lack those structural guardrails. The market is an environment of pure, unadulterated freedom. When you combine an environment devoid of limits with the endless depths of human desire, that optimism rapidly curdles into sheer fantasy. You just abandon risk management because you become entirely seduced by the magnitude of the potential reward.
It makes me think of the mechanics of an all-you-can-eat buffet, but like one that lacks any external constraints.
Okay, I like where this is going.
Imagine a buffet where the food is constantly replenished, the lights never turn off, and there is no staff member who will ever tap you on the shoulder to tell you the restaurant is closing.
That sounds dangerous.
Right. Human beings evolved in environments of scarcity, so our biological programming tells us to consume resources whenever they're available. If you place a human in an environment of infinite calories and remove the external stopping mechanism, the closing time they will eat until they cause themselves physical harm.
Yeah, they won't stop on their own.
Exactly. The boundless nature of the buffet is not a gift. Without a fiercely conditioned internal stopping mechanism, the infinite environment is a direct hazard to your survival. This is kind of what the texts are getting at.
That analogy perfectly isolates the danger of the unlimited. The market operates exactly like that endless buffet. Without a predefined exit strategy, without deciding internally, long before you take a position, exactly when you will walk away, the market can and will move against you indefinitely.
Because it just doesn't care.
Exactly. It possesses the mechanical capacity to consume your entire net worth, simply because the environment is completely neutral. It has no safety net, no manager, and no dealer to tell you that you've had enough.
Okay, so we've established this massive lack of structure and how it feeds that illusion of fulfillment. The texts then take a really fascinating pivot into cognitive neuroscience.
Yeah, this is where it gets really interesting.
What actually happens in our brains when we are gripping this fantasy of limitless wealth and the real-time data of the market starts to disagree with us? Let's say a trader takes a position. They have attached their dreams of quitting their job to this specific asset, but the price starts dropping. The numbers turn red.
Right. Our audience is likely well-versed in the standard concepts of confirmation bias, right? Like how we favor information that aligns with our political or social views.
Sure, we all do that to some extent.
But what the sources explore is how acute financial risk weaponizes that standard bias into two heavily intertwined survival-level mechanisms. They call them selective perception and selective exclusion.
Okay, break those down for us.
When you deeply believe a trade is going to change your life, when you've inextricably linked your emotional and financial well-being to a singular outcome, your brain actively begins to filter the live data stream the market is generating.
And it does this not as a conscious choice, right? But as an automatic defense mechanism. The texts explain that selective perception causes the brain to aggressively highlight any data point that supports the prevailing belief.
Yes, a trader will hyperfixate on every single microscopic upward tick, interpreting it as proof that their thesis is correct.
But the far more dangerous mechanism is selective exclusion. This is where the brain literally builds a cognitive firewall against threatening information. Are they literally just not seeing the bad numbers?
They see the red numbers, but their mental processes strip that data of its actual meaning. They ignore the broader downward trend, they rationalize the collapsing volume, and they dismiss the fundamental indicators that the thesis is failing.
That's wild. Why would our brains do that?
The brain is doing this to maintain the pleasant delusion of future wealth and to stave off the immediate neurological pain of admitting defeat. It is a remarkable vulnerability. We are taking an evolutionary survival mechanism designed to protect our psyche from trauma and applying it to a digital numbers game where that exact mechanism ensures our financial destruction.
Wow. And this cognitive filtering creates what the authors identify as the hope spiral, right?
Yes, exactly.
The hope spiral is one of the most brutal concepts in the material. It describes the anatomy of a catastrophic loss. You have a market participant holding a losing position. The price moves further and further away from their initial entry point, but instead of executing a rational exit, they remain frozen.
They just sit there.
Yeah, they sit in front of the screen and essentially hallucinate a reversal. They start scouring financial forums, social media, news feeds, actively hunting for the one obscure analyst or the single data point that validates their failing position.
All while entirely ignoring the mountain of evidence screaming that they're wrong. And they're building a wall of justification between themselves and the empirical reality of the screen. A downward movement in price is no longer processed objectively as the collective market is valuing this asset less than I paid for it.
Right, it gets distorted.
Totally distorted. It's processed through the lens of the hope spiral as, oh, this is merely a temporary dip manipulated by institutional players, and it's setting up for the inevitable massive surge.
And the sources are incredibly stark about how this spiral concludes. It does not end with a gentle realization.
No, it really doesn't.
The text is brutal about this. The participant only exits the trade when the magnitude of the financial loss becomes so overwhelmingly massive that the raw panic of losing every single cent they own finally outweighs the ego-bruising pain of admitting their analysis was incorrect.
It functions as a grim equation of pain thresholds. Admitting failure inflicts psychological pain. It shatters the illusion of fulfillment, forcing the individual to accept that they are not getting the financial freedom they mentally spent. So to delay that pain, they utilize selective exclusion. But the market's continuous motion means the financial bleeding accelerates. Eventually, the very real threat of total financial ruin supersedes the emotional discomfort of being wrong.
So this requires us to look closer at the concept of pain itself within this environment, because the entire hope spiral, all of this complex cognitive filtering, is ultimately just a desperate attempt to avoid pain.
Precisely.
The text defined pain in this specific context, not as physical injury, but as the friction between unfulfilled expectations and empirical reality. It is the severe cognitive dissonance that occurs when your deeply held belief about what the market should do violently collides with the reality of what the market is actually doing.
And the wider the gap between the internal fantasy and the external reality, the more intense the psychological pain. Humans are biologically hardwired to avoid pain at all costs. Therefore, to protect ourselves from the pain of these unfulfilled expectations, we deploy the mental defenses of denial, rationalization, and justification.
Which works in normal life sometimes, right?
Yeah, it does. But the fatal flaw in this biological response here is that the market is a completely neutral entity. It does not care about your cognitive defenses. It simply continues to generate new price data. Eventually, those internal distortions stretch until they snap, leading to a psychological event the authors term forced awareness.
Forced awareness. You know, that concept reminds me of dealing with deferred maintenance on a house.
Oh, that's a great way to look at it.
Yeah, let's say you notice a faint water stain on your living room ceiling. You know, logically, it indicates a leak. But calling a plumber means facing a frustrating, unexpected bill today. So you employ selective exclusion.
Right. You tell yourself it's fine.
Exactly. You rationalize that it hasn't rained much lately or that it's an old stain you just never noticed. You are living in a hope spiral, expecting a physical deterioration to magically reverse itself. You only gather information that supports your hope, like noting that the forecast calls for a week of sunshine.
You're delaying the immediate minor pain of a repair bill by distorting the reality of the structural damage.
Exactly. You ignore the signs until months later, when the floorboards have rotted through, the drywall caves in, and you are staring at a massive, catastrophic structural repair bill, and the roof literally collapses on your head.
Yeah.
That is forced awareness. It is not a sudden random lightning strike of bad luck. It is the inescapable compounding cost of a reality you actively refuse to acknowledge. The reality of the leak was always there, accumulating damage, but you used your mental defenses to ignore it until the environment forcefully and expensively imposed its reality upon you.
The compounding cost is the crucial takeaway there.
Yeah.
And the sources introduce another variable that dramatically accelerates this entire destructive process,
Which is
the concept of scared money.
Oh, wow. Yeah, this shifts the stakes from the theoretical to the existential. Because scared money refers to capital that an individual actually needs for their immediate survival money earmarked for rent, groceries, or medical bills.
Exactly. When a participant enters the market using scared money, the psychological pressure is intensely magnified. The objective shifts from seeking theoretical financial independence to demanding that the market provide for immediate basic survival needs.
That's a huge burden to put on a trade.
It is. This profound, desperate need to fulfill immediate financial obligations heightens selective perception to highly dangerous levels.
Because the pain of an unfulfilled expectation is no longer just a bruised ego or a delayed retirement. The pain of the market moving against a scared money position translates directly to eviction or starvation.
Right. The biological threat response kicks in.
The conflict between the belief, this trade absolutely must win so I can keep my home, and the reality the trade is actively losing value. It becomes so neurologically unbearable that the executive function of the brain just shuts down. The mental defenses go into hyperdrive, blocking out the threatening information far more aggressively. Because acknowledging the reality of the screen means acknowledging a direct threat to physical survival.
It creates an impossible environment for rational decision-making. I mean,
Yeah.
you simply cannot process market data objectively when you are terrified of the outcome. The survival instinct demands certainty, and the market only offers probabilities.
So if our biology is fundamentally mismatched for an environment with no boundaries, and our brains are naturally wired to filter out bad news to protect us from cognitive dissonance, keeping us locked in a hope spiral until our portfolios collapse, how do we survive this environment?
It's the multi-million-dollar question, isn't it?
It really is. And the sources dedicate significant time to the actionable solution here, which revolves entirely around taking back control by building the architecture yourself. If the market refuses to provide a structure, you must become the architect of your own boundaries.
Yes. The foundational rule presented in the texts is that these self-imposed limits must be created and locked in before the market exposure begins. Before. This is the absolute non-negotiable necessity of what the authors call the stop-loss habit. A participant must never enter a trade without establishing a hard stop-loss. That's a predetermined mathematical price level at which they will automatically exit the position if the market moves against their thesis. It is the artificial external boundary you impose upon a boundless, chaotic environment.
So returning to our initial casino comparison, implementing a strict stop-loss habit means you are essentially acting as your own casino house.
Yes, exactly that.
You are looking at your capital allocation before the trade and dictating the terms. You decide in a state of calm rationality, this is the maximum allowable loss. When this predetermined amount of capital is gone, the position is liquidated, no questions asked. You are taking the predefined, contained risk structure of gambling and hard-coding it into the limitless expanse of the trading environment.
You are intentionally providing the rigid limits that the market lacks. However, and this is a big however, the texts explicitly highlight a common fatal pitfall.
I think I know where this is going.
The entire system collapses the moment a participant decides to move or remove that stop loss while the trade is active.
And this is where the psychological discipline is truly tested, isn't it? I mean, what happens when a trader decides to move it? A trader sets the stop loss perfectly before the trade. But as the live price approaches that line, the pain of impending failure flares up. So they drag the stop loss line a little further down on the chart.
Yep, we see it all the time.
They tell themselves they are just giving the trade room to breathe, or that their indicators suggest a reversal is imminent. But in reality, they are completely abandoning their self-imposed limits and surrendering back to the hope spiral.
Moving the stop loss mid-trade marks the exact moment an individual stops managing financial risk and begins exclusively managing their own emotional discomfort.
Wow. Managing emotional discomfort instead of risk.
Right. They are prioritizing the temporary delay of pain over the preservation of capital. To combat this, the texts urge a radical shift in how participants evaluate market activity. You must strip away your personal need for money and evaluate the market based solely on the consistency of market participants. That is the real force at play.
Let's unpack the consistency of market participants, because it shifts the entire paradigm of how we view the numbers on the screen. It means recognizing that the market is not a singular adversarial entity.
No, it's not out to get you.
It is not a wish-granting machine either, and it does not know you exist. The market is simply a raw, neutral data stream representing the collective actions and behaviors of millions of other human beings buying and selling. If the price of an asset is moving against your position, it simply means that in this specific moment, the collective force of other participants values the asset less than you do.
It is a factual, empirical reality.
Yeah.
Your internal, deeply held belief that the asset should increase in value is entirely irrelevant to the collective mechanical force of the market. Shifting to this mindset allows you to stop projecting your personal desires, your need for rent money, or your fantasies of wealth onto a neutral price chart.
And to maintain this objective mindset, the sources provide an ultimate reality check question for traders. It is a cognitive tool designed to pierce through the fog of selective perception. Whenever you are analyzing an active position, you must pause and ask yourself, am I seeing what is actually happening, or am I seeing what I desperately hope will happen?
It is a brilliant mechanism for forcing accountability. If you answer that question honestly, it immediately dismantles the mental defenses. It demands pure objectivity. But, and this is the crux of the entire methodology, you can only achieve that level of calm objectivity if you have fully accepted your risk in advance.
It all comes back to the stop loss.
Exactly. That is why the predefined stop loss is the linchpin of survival. If you know with absolute certainty that the worst-case scenario is a strictly quantified loss that you accepted before the emotional turbulence began, you strip the fear out of the equation.
Because there is no longer an unknown existential threat to hide from. If your boundary is rigidly set and you are not trading with capital required for your survival, your brain does not need to deploy selective exclusion to protect you from the downward ticks.
Right, the threat is contained.
You can watch the price action and calmly observe, the collective market is trending down today. My thesis was incorrect, but my capital is protected by my stop loss.
The elimination of fear is the prerequisite for clear, unclouded vision. When the fear of the unknown is removed by a predefined limit, you can finally interact with the market as it truly is, rather than how you need it to be.
We have covered some intense psychological territory today, exploring the mechanisms that govern our decision-making under pressure. Let's distill the core insights from these behavioral finance texts for you so you can take them with you. First, the financial market is an entirely unlimited neutral environment. Because it lacks external boundaries or safety nets, survival absolutely requires you to engineer your own limits. You must act as the architect of your own risk, serving as the casino house for your own capital.
Absolutely essential.
Second, the aspirational fantasies of the big win, that illusion of fulfillment, they are not harmless optimism. They are the primary catalyst for catastrophic loss because they trigger the hope spiral, activating biological defense mechanisms that literally blind you to the empirical reality of the data right in front of you.
And third, integrating all of these concepts. Successful navigation of a limitless environment requires you to operate without fear. The only mathematical way to eliminate that fear, and thus preserve your objective perception, is to predefine your risk with a hard stop loss before exposure begins, and to never expose capital that is required for your basic survival.
Mastering the market is ultimately just an exercise in mastering your own psychological discipline. As we wrap up this deep dive, I want to leave you with a final thought to mull over, one that stretches far beyond the glow of a trading screen.
I like where this is heading.
We have spent our time today analyzing how the total lack of external limits in the financial markets brutally exposes our cognitive blind spots. It demonstrates how rapidly we default to selective perception and hope, rather than dealing with the cold, empirical reality of the present moment. But where else in your life is this exact dynamic playing out?
That is a great question.
Where else were you operating without predefined boundaries, letting a situation drift indefinitely because you refuse to set a hard limit? Perhaps it is a stagnant career path, a draining relationship, or a personal project that is silently consuming your time and energy.
The leaky roof.
Exactly. Where are you ignoring the compounding water damage on the ceiling, trapped in your own hope spiral, convincing yourself that things will magically improve simply because the pain of admitting that the current reality doesn't match your initial fantasy is too high? Think about the areas in your life where you have failed to define your acceptable losses. Because whether it is in the markets or in life, an environment without limits will always consume whatever you are willing to give it. Until next time, take a hard look at your boundaries and set your limits before the environment decides to set them for you.